Okay, good morning. Welcome to FX Primus. Thank you for joining me on this is our second webinar now in a series of webinars designed to take a complete beginner and convert them into a full-time foreign exchange trader. Now, before I start, let me remind you that trading is, of course, risky, not appropriate for everybody. Past performance does not guarantee future results. So please never risk money you cannot afford to lose. My name is Peter Petru. I'm a full-time trader, FX market strategist and guest speaker here at FX Primus, where I hope to share my many years of trading experience and knowledge to help those of you who want to learn how to trade successfully, or maybe you have been trading but would like to improve and take it up a step to the next level. We do these webinars every Monday and Thursday for free. All you have to do is register with FX Primus, and the sessions are recorded and available in the members area, so please do take advantage of that and go over the material until you're happy and clear with what's been covered. I will also be holding Q&A sessions where I will answer any queries you may have regarding anything I've covered in the webinars, or maybe you've got any general questions you have about the FX market, or even your own trading. Right, so this session we're gonna talk about the benefits of trading forex versus stocks or futures. Forex market participants, who are they? We're going to look at brokers, market makers. Then we're going to talk about, is there a best time to trade forex? And if so, when is that? The range of the market, how it ranges during the day, because it's not the same throughout the day. It changes depending on whether Tokyo is awake, London is awake, or New York is awake. Are there any particular pairs that I should trade? And if so, which ones and at what time? And is one day of the week perhaps better for trading than another? Now, if these are all the kind of questions you'd like answered, then stick around for the next hour. Okay. All right, so let's get started. Firstly, why trade forex? I mean, why not stocks or futures? Well, when you trade forex, well, let's start with stocks. When you trade a stock, for example, you buy Apple, and the stock is trading at $116. You buy some shares. You have to pay your broker a commission for placing that trade for you. Now, the commission will vary from broker to broker, and it will vary depending also on the type of order it is. There might be some hidden fees, such as for transferring assets both into and out of your account. With spot forex, you don't get any of these costs. If you don't know what spot is, by the way, you need to go back and watch the previous webinar. So yeah, in forex, spot forex, you don't pay a commission or a fee, if you like, to the broker when they place or process your trade. And why is that? Well, the broker is compensated through something called the spread. That's the difference between the buy price and the sell price. So just quickly on spread. The spread is simply the difference between the buy price and the sell price. So Let's have a look at an example. If we look here on this red, in this red image, that's the euro dollar, and you've got the sell price on the left and the buy price on the right. Let's look at the large numbers for now. The selling price for euro dollar is 104.41. The buy price for euro dollar is 104.46. Now, the difference between the two prices is called the spread. So in this example, the spread is 5 pips. Now, I've exaggerated the spread a little here, just so I can clearly make a point. But you know, you usually find it's much smaller than this. So, whereas with stocks, you often have to pay, I don't know, exchange fees or clearing fees. With forex, you don't have any of these commission costs. So that's one advantage. What else? Well, because forex isn't traded on an exchange as such, you're therefore not limited to the hours of trading. So let's take, for example, most of us have heard of Marks and Spencer's. Yeah, most of us have probably got an item of clothing from Marks and Spencer's, usually bought for us by one of our aunts for our birthday. And let's say you like Marks and Spencer's and you want to buy some shares in Marks and Spencer's. Well, they trade in London on the London Stock Exchange. Is the London Stock Exchange open 24 hours a day like forex? No. London Stock Exchange is open from 8 o'clock in the morning London time until 4:30 in the afternoon London time. So if you want to trade Marks and Spencer's shares, then you need to do so during these London Stock Exchange hours. And let's just say you were sitting there watching the news. The London Stock Exchange is closed for the day. You hear something on the news, something Marks and Spencer related. You can't trade Marks and Spencer's shares because the London Stock Exchange is closed. Now I know we've got American depository receipts, ADRs. I'm not going to get into those at the moment. The point here is that stocks and shares are limited to the times the exchange is open. If you're in Tokyo, for example, the London Stock Exchange is closed for almost your entire working day. So exchange opening and closing hours limit your ability to trade stocks. We don't have this problem with forex, which runs 24 hours a day, 7 days a week. You can trade forex 24 hours a day from when Tokyo wakes up on Monday morning, their time, until the Americans go home on Friday afternoon. This is particularly helpful if, for example, you're not a full-time trader and you're learning, like many here listening are, you're learning how to trade. You can trade after work or in the evening or on a part-time basis. You have that choice, which perhaps you don't have with stocks. What else? Okay, let's look at futures market. Lot sizes or contract sizes. Like, what's the minimum I have to purchase? It's a standardized amount. What do I mean by this? If you trade NYMEX gold futures in lot sizes of 100 troy ounces, which is the standard size, if you wanted to trade 1 troy ounce, you couldn't. Yeah. If you were trading silver futures, you'd be trading in lot sizes of 5,000 ounces. Even with forex, if you go into the futures market, that's a standardized contract of 100,000 units. Now I know there's smaller contracts out there which are offered, but they're not as liquid and they're certainly not as flexible as, say, the spot forex market. I mean, if I compare the futures market just on forex to the spot forex market, in spot forex you can trade $500,000, you could trade $10,000, $5,000, you could trade $100 if you want, or $50, or even less. You decide. Now this flexibility has its advantages over fixed lot sizes imposed by assets which are trading on an exchange. And then of course, what about the size of the forex market versus the futures or the stock market? Liquidity is not really comparable when you think about it. I mean, if we look at the retail spot aspect of forex trading, just the retail aspect, we're still looking at way over $1.5 billion a day. Sorry, $1 trillion a day. And if you compare that to 20 or 30 billion in the stock market or futures market, you see there's no real comparison. Due to this enormous size of the forex market, it's very, very difficult for anyone, any large net worth individual, or even a bank, or even a government, central bank, to influence the price of a currency simply by trading it. Whereas it is a hell of a lot easier to try and influence the price of a stock simply by trading it. Yeah. So this huge liquidity in the forex market also means that, of course, any order under normal market conditions, any order you put through will be executed instantly. Now, I'm not going to go any further into market size and liquidity, as we covered it quite well, I think, in the previous webinar. So please go back and have a look if you haven't done so already. Okay, what else? A rumor about a stock. Let's say there's a rumor going around, or an analyst on the TV is recommending the stock, or a broker is recommending a stock. You often find that they can influence the price of that stock, sometimes unjustifiably. Now, try doing that on forex. It's not so easy. You know, not so easy when you can trade, say, $150 million on the euro-dollar price and it won't change. It's not so easy to manipulate the price when liquidity is beyond anything you'll see with a stock. Another point to consider actually is this. The stock market has many different companies listed. Now obviously it's important as a stock trader to follow many of these companies, understand management, the balance sheet, other companies in that sector. So this could mean that you have to closely follow quite a few different companies. And now in forex, there aren't hundreds and hundreds and hundreds of different currencies to follow like there are hundreds and hundreds and hundreds of different companies to follow in the stock market. I mean, you've only got like 8 major currencies. So, and of these, I'd say you could quite easily make a living just following 4 of them, 4 or 5. So you can see, I mean, following 4 or 5 currencies, it's a bit more manageable than following, say, 30 companies over 2 sectors. Actually, I should mention that there are, of course, no restrictions on short selling a currency. So by short selling, I mean selling to open a position first and buying to close the position later. Yeah. So if I didn't have a position open at all on anything, but I thought that the euro-dollar price would fall, I could just sell the euro-dollar price now and buy it back later, hopefully at a lower price. Now, in the stock market, there are restrictions to doing this, namely this uptick rule. This was implemented in, I think it was February 2010 by the SEC. The SEC is the Securities and Exchange Commission in the United States. They regulate the financial markets. And this basically restricts you from short selling a stock unless there's been an uptick in the price. We also have short selling regulations actually in the UK since November 2012. So the fact that I can freely trade a currency pair in any direction at any time without restriction is definitely something many people use to their advantage. So when we look at forex versus futures and stocks, there seems to be a lot of advantages in trading forex, and this is a big reason I think why forex is such a fast growing market, particularly in terms of retail traders. Okay, so far where are we? You should easily be able to answer these questions now. What are the trading hours of the spot forex market? What is the lot size in spot forex? Which market has more liquidity, stocks, futures, or spot forex? Okay, moving on. Who are the forex market participants? Who's involved in this market? Well, there are many. Let's start off with probably the largest, the major banks. So UBS, Barclays, Deutsche Bank, etc. They operate in what is called the interbank market. Now this is, if you like, the very top level of forex trading. It's where all the major banks in the world exchange different currencies amongst themselves. This is where most of the volume is traded in the forex market. And again, there's no centralized exchange like there is with stocks. So you may hear people actually refer to transactions as OTC, which simply means over the counter. All spot forex transactions are labeled OTC because they're not made through a centralized exchange. So whereas, for example, Apple is traded in a centralized exchange called the NASDAQ. So this at this interbank level, you'll find banks trading currency to each other, and they do so in very large sums and with very, very tight spreads. Nothing like that example I showed you earlier on the euro dollar. Now these banks, they trade with each other electronically using EBS, which is an electronic broker service. Electronic broker services, or maybe there's a competing service actually from Reuters called the Reuters D-Link 3000 spot matching system. Now we're not a major bank, so I'm not really going to go into too much detail on how this side of things work. But what I will say is not all of the banks get the exact same rate. Some of the more credit-worthy banks you'll find often get a slightly better deal than the smaller banks. Okay, who else is in this forex market? Well, then you have people like the hedge funds and other similar financial institutions. what is a hedge fund? I know someone's going to be asking that. A hedge fund, for those who don't know, is simply an investment fund which speculates on the financial markets. Okay. You also have companies. Many companies need to purchase goods and services from other countries when doing business. And they therefore need to pay for these goods and services in the other currencies. So let's use Apple again as an example. Apple depend on some Chinese manufacturers for its products, and as a result they will have to pay for a lot of these expenses in Chinese yuan. Now, Apple will trade large amounts of money, exchange large amounts of money, but they're not anything like what a major bank will trade, so they can't do their business at the interbank market level, and instead they carry out their transactions via one of these commercial banks. So you have hedge funds, you have companies like Apple, you also have market makers. Now, does anyone know what a market maker is? I used to work as a market maker. A market maker is a broker-dealer firm, usually, who is willing to buy or sell an asset at the same time. And what this does, it facilitates the trading of that asset. So what do I mean by this? If I was a market maker for euro-dollar, for example, I would be willing to buy euro-dollar and I would be willing to sell euro-dollar at the same time. I would say, for example, the price is 104.50 to 104.52, which means you can sell euro-dollar to me, the market maker, at 104.50, or if you want, you could buy euro-dollar from me at 104.52. You decide. I have made a market for you, a market which has a price, a buy price, and a sell price. Yeah, pretty simple. And the other one on that list is ECN. An ECN is typically a broker-dealer who uses an electronic communications network. Now, an ECN it's simply a computer system that, again, facilitates the trading of forex, in this case, by allowing participants direct access to quotes from other banks and financial institutions. So, although ECN brokers usually charge ECN brokers when I was talking about stocks earlier, they usually charge a commission, and I said in forex they don't. Well, ECN brokers are an exception to this. They will usually charge a very small commission for their services. Now, again, these guys are not major banks and are therefore not part of the interbanking system. They have to do their transactions via the commercial banks, and as a result they will get a slightly worse rate when compared to the major banks trading with another major bank. Okay, and then lastly, retail traders. That's us. Now, as we've moved down that list, you'll notice each level gets a slightly worse rate than the one above, but still a great rate. I mean, in the past it was not easy getting access to any of these foreign exchange markets. I mean, other than the awful rate that you get at the tourist office when we, change up money and you go on holiday. But now we can access the forex market through electronic trading platforms and retail brokers such as FX primers. It's something we couldn't do until it's probably around the late 1990s, maybe very late 1990s. Before that you had to have something like $50 million to get started in forex. But with the internet, this has brought about many online forex brokers who have brought the forex market to many of our computer screens. Retail forex traders obviously do not get as favorable a rate as a major bank in the interbank market does. But as I said, this is a fiercely competitive industry, and you'll find that the rate available to retail forex traders who are trading tiny amounts of money is surprisingly not that far away from what major banks who are throwing around many millions of dollars get. Now, something I've not put on that list actually, and I should mention, is of course governments and central banks. They also participate in the forex market. Governments obviously need to make international trade payments, or they may want to sort of adjust or alter the amount of foreign exchange reserves they hold. So of course they also participate in the forex market a lot like companies do. Right, okay, I think that's got a little bit there about the forex market and its participants. And what about this? When is the best time to trade forex? So just because the forex market is open 24 hours a day, does it mean we should trade it at any time of the day? There is such thing as a best time to trade forex, and we're going to discuss it now. Right. So firstly, the forex market can be split into three main trading sessions: Tokyo, London, and New York, or Asia, Europe, and America. Some may also want to add a fourth, Sydney, but I kind of put Sydney in with Tokyo, put it in the Asia session. So remember, if a currency doesn't move, i.e. if the price stays the same, then it's difficult to make any money. We rely on the price changing to make money. So if I buy a Eurodollar and I want the price to change, preferably to go up so I can make some profits, and it doesn't and it stays, I'm not going to be making any money. Now, what we need to ask ourselves is, how will that price change? And it's simple. Lots and lots of money being traded in one direction. Yeah? So we need hundreds of millions of dollars to be traded so we can get the euro dollar price to change. Now, when is this more likely to happen? When the traders are asleep, like the guy here on the left, or when they're at work, which is the chaos you see on the right. Yeah. If most people who work at banks, hedge funds, broker-dealer firms, etc., if most of these people are asleep, then we probably won't see much action on the exchange rates. In fact, you can almost instantly see the moment when these people start work, because the price starts moving. You start seeing fluctuations. So for example, in London, the stock market opens at 8 a.m. London time. If you looked at the markets at 4 o'clock in the morning or 5 o'clock in the morning London time, most of the financial world is asleep. Not much tends to move at this time of the morning. However, come back at 7 o'clock in the morning London time, and you will start to see noticeable changes in price movement. any time between sort of 7 and half 7, definitely somewhere around there, you will see some changes. And then 8 o'clock, you're gonna notice 8 o'clock when that London market opens. Even though you've got nothing there to measure volume, you'll be able to see just the way the price moves that people have started work in London. Banks have opened up. And this goes all the way through to like 11 a.m. London time. Lots of money is being changed hands. Lots of traders are at work. The European banks and financial institutions are all they're all open for business, and prices start moving. So I'm in London. I'm in London, and I keep an eye on one of the most important indicators in forex, and you should write this down: the clock. I know that approximately 11 o'clock in the evening, my time, London time, banks and businesses in Tokyo start opening up for business, followed by many other Asian markets. So if I wanted to trade in the evening, I wouldn't trade at 9 or 10 o'clock at night in London. I would rarely see much movement at these times. I would wait. I'd wait until the Japanese market opens or the Asian market opens, when people are at work. Yeah. Now, the reason I'm saying this, guys, is because some people look at trading as simply a mathematical enigma that they need to sort of figure out. And it's not always as complicated as that. Trading is largely understanding people, knowing the simple things like when they go to work, when they go to lunch. You'll often see a trending move in London, which has started at 7:30, 8 o'clock, only for it to suddenly die out by about 11, 11:30 London time. And why is that? Well, many speculators probably go and get some lunch. Yeah? They unwind their positions. I know to some this seems a difficult thing to understand, but it's true. Just look at the charts and plot the time, and you will see this pattern over and over again. Then suddenly at 1:30 London time, things start moving again. Why is that? Well, the Americans have woken up. New York, they're getting into work. The banks are opening over there. Transactions are coming through. Economic announcements at the start of their working day. All these things mean we can predict when there will be an increase in both market participants and therefore volume, which in turn quite often results in currency moves. And we want to catch those moves. So how do they move? Well, or how much do they move? It varies every day, but let's look at, say, Eurodollar, the most liquid traded currency pair. The Eurodollar moves over 70 pips during a Tokyo trading session. Oh, by the way, a pip is a term we use in forex, not the hard seed you find in fruit. Pip stands for point in percentage. So simply speaking, a pip is how do we measure when we're looking at stocks, for example, and we can measure a stock in cents or pence if it's a London-based stock. In currency, a pip is how we measure a single-digit change in forex. So, for example, Eurodollar 104.50. If it changes to 104.51, then we would say that it has changed by 1 pip. Okay. So the Eurodollar moves, let's say, 70 pips a day on average during Tokyo session. It moves on average more than 90 pips, over 90 pips during New York. And again, it moves on average way over 100 pips during the London trading session. So what does this mean? If you wanted to make money trading the euro dollar, it'd be a good idea to trade it when it moved. And these 3 trading session hours, Tokyo, London, New York, are good examples of when it moves, with London providing the biggest average daily moves. Now if we look at the other major currency pairs, you will see a similar pattern, not just the euro dollar. Generally, the London or the European session tends to host the largest, strongest moves. If we look at pound dollar, for example, we'll see that moves on average probably well over 110 pips per day during the European trading session hours. That's greater than New York, where we'd probably see cable. I can call it cable now. You guys all know what cable is, pound dollar. Yeah, in New York, well, let's just say over 90 pips a day on average on cable in New York. And by the way, the figures I'm giving you here are going to take into account some slow years in forex, so they're quite conservative. Now Tokyo, when I say Tokyo, I mean the Asia session, the working trading hours of Asia. That tends to always provide us with the lowest daily pip moves out of the 3 trading sessions. And it doesn't mean that this Asian session is small. I mean, on the contrary, it's probably around 1/5 of all foreign exchange transactions. Probably 1/5 of all volume takes place during this session, so it's a huge session. You'll often see like pound yen move very well during the Asia session. I mean, way over 60 pips, 70 pips, way over that. And again, when I say Asia session, I don't just mean Tokyo. Tokyo just is the financial capital of Asia. Similarly, London is the financial capital of Europe, and New York for America. So, yeah, obviously trading isn't mostly done just in Tokyo. I mean, it's Hong Kong, Singapore, Sydney. These are all, they contribute hugely to the Asia session. However, I will say this: of the 3 sessions, Asia can be a little light. And what do I mean by that? It usually doesn't have as strong a move as you will see in the European session or New York, for example. Asia tends to, it doesn't move as much. It doesn't have as much liquidity, I don't think, as the other 2 sessions. So you may want to avoid holding a position, or you may want to lower your expectations in relation to how far a currency will trend when you are working during an Asia session. Maybe be a little bit more short term. We'll talk more about this later on as the course goes on there. I'm just trying to give you an idea of the characteristics of the different trading sessions and different times of the day, because that's very important to know. What pairs should I trade during the Asia session? Well, you'll likely see stronger moves on Asia currencies. And why do I say that? Again, think about it. Australian dollar, New Zealand dollar, you're going to get news. Australia is all the people at work. You're going to get a better move. A lot of the business transactions will be done at that time of day between these countries, Australia, Japan, New Zealand, as opposed to, say, for example, the pound dollar or the euro dollar, because the English and the Europeans are still asleep. Their banks are closed. They're not doing any large foreign exchange trades at that moment in time of the day. Sorry, I was just getting a bit of water. However, we often find that a move in Asia is followed by a similar move in London. And what do I mean by that? If I see a trend developing during the Asia session, I often see that trend continuing during the European session. The Europeans will trade a lot of the time in the same direction as the Asia trend. So again, let's think of trading in terms of people. If we do, then it's no surprise that during the Asia session, when Asia is at work, we will have news announcements from various countries of that region. So news regarding New Zealand or Japan are released, and that will of course cause the New Zealand dollar or the Australian dollar or the dollar yen, I'm mentioning majors here, to move in response to the news events being released. In fact, the yen pairs in general are also ones to watch during that session, as so much yen is being exchanged by the banks and different companies as they do business during their normal working day. Then as the Asian day comes to an end, and they finish work, the European session starts. Yeah, and the banks open across the continent. People start work, trades start getting placed. Clearly the first thing that the European traders are going to do in the morning is they're going to look at what happened in Asia. What did they do and why? Yeah. London is probably the capital of the world when it comes to foreign exchange volume. I'd say probably a third of the world's foreign exchange happens during that London session. Similarly to the Asian session, of course, news will focus more on the currencies and countries which are awake and are at work. So during the London session, you'll find news and announcements for the Eurozone, for the Switzerland, for the UK, and you'll see the euro dollar, the pound dollar, the dollar Swiss, etc. All these currencies are going to, these major pairs, but actually not just the major pairs, because it's such a liquid session. You will see moves on even crosses like the euro yen and the pound yen, especially. Crosses usually, they do not have as tight a spread as the majors. We talked a lot about crosses. If anyone's wondering what is a cross, a cross is just a currency pair which isn't a major, which isn't a dollar pair. We talked about crosses in the last session, so again, feel free to go back and watch it if you need a refresher. Now, the New York session, moving on from London, the New York session, like London, is highly liquid. And again, we see nice moves, particularly in that overlap, the New York morning, London afternoon, where both America and Europe are awake and at work. So you'll often find there's a lot of trading going on around 9 o'clock in the morning New York time. And of course, this is, let's not forget that the vast majority of all currency trades are dollar trades. And you get most economic data is released in the morning before the New York Stock Exchange opens. And this economic data, which is in relation to the US economy and therefore the dollar, is going to have a huge impact on the markets and their prices. You'll often get moves that last right through the New York morning, and then all of a sudden things start to die off. Why is that? Moves, they just seem to stop going. Well, at around New York lunchtime, the European banks and financial institutions close. Yeah, it's that simple really. A large portion of the market goes home and finishes work. It's amazing how you will see this reflected in the trading. Moves often grind to a halt, and even a reverse. They even reverse a little as traders take profits. So it's vitally important that we think of the market as people. People who wake up in the morning, they go to work at the bank or hedge fund or wherever they be. Once these people finish work and go home, their trading stops as well. Quite often you'll notice that Friday afternoon, London time, GMT, Friday afternoon, not the best day of the week to get into a trade. Yeah, many traders are, they're likely to want to get out of their trades for the weekend and hence not hold anything overnight like they may do on a Tuesday. I mean, would you want to risk leaving a trade on over the weekend? What if some news is released which is bad for your trade? You can't trade again until the Asia session starts work on Monday morning, their time. So you want to manage your risk and limit your exposure to the news events over the weekend, and therefore you'll find a lot of traders wind down their positions, take profit on the Friday afternoon. Yeah. So the day of the week and the time of day is very important and makes a huge difference when analysing the market. So for example, you're looking at charts, you're trying to analyse the market, and you've decided, I think this is giving me a buy signal. My analysis says I should buy. Now, if I would think very differently looking at the exact same thing if it was 8 o'clock in the morning London time versus 4 o'clock in the morning London time. Yeah? Obviously, the busiest time of the day is when New York and London are open. My expectations are much lower if Europe is asleep and the USA is asleep. Similarly, if you want to place a trade at around New York lunchtime, you ought to consider that the London traders are finishing work and liquidity is about to start drying up. In fact, the trend, as I said before, could start to reverse as the London traders start taking profits. The process of taking profits means you trade in the opposite direction. So for example, if the euro dollar has been going up all New York afternoon, you've been buying euro dollar's going up. The only way to cash in and take your profits is to now sell the euro dollar. So it's not uncommon for it to fall by New York lunchtime as traders sell the euro dollar and close out their positions and take profit. Okay, what about the best days of the week to trade forex? Well, if we look at the average pip range for each of the major pairs for each day of the week, we would see that Tuesday, Wednesday and Thursday are in fact the busiest days of the week. and Friday morning actually. This is where we see the highest pip ranges. So for example, let's look at the London session, which is the busiest session out there of the three. If we look at, say, euro dollar for the London session, we would see that on Monday it probably has a range of around, I don't know, 100 pips. On Tuesday it's more like 150 pips. On Wednesday maybe around the same, 140, 150 pips. Again on Thursday 150 pips or more. Yeah, we see similar results. And then Friday morning, again, a good range of pips. Friday afternoon, all of a sudden, it dries up. And it's not just for euro dollar. We see similar results for pound dollar, dollar yen, Aussie dollar, pound yen. Monday is almost always the quietest day of the week for all the pairs. Tuesday, Wednesday, Thursday, Friday morning, they tend to host the larger moves. Yeah, Friday morning GMT is what I mean. And Friday morning GMT is completely different to Friday afternoon GMT. Alright, so we can see that although the forex market is 24 hours a day, there are certain days of the week and certain times of the day and even certain currency pairs that offer more favorable trading opportunities to us than others. So it's not just about learning when to trade. I hope today that many of you have learned a bigger lesson, which is when not to trade, because that's where most of your losses will be. So to recap, when is the worst time to trade? Tokyo lunchtime and afternoon. Friday afternoon, again, not a good time to trade. GMT I'm talking now. Oh, and let's not forget holidays. Thanksgiving, Christmas, these are not very liquid days to be trading, and the market can behave unpredictably. Months of the year, June, July, August. Traditional summer months, people go on holiday. They tend to be the months of the year many people are not at work, and it's no surprise that these are the quietest months of the year trading volume wise. If you was to compare June to August, those 3 months, and then compare September to December, you'd see a huge difference regarding volatility and volume. And again, other national holidays, not the best for liquidity, as many traders are simply not at work. It's as simple as that. Thanksgiving, President's Day, Martin Luther King. So it's very important that we've got the economic calendar there so we can see where there is a holiday. Okay. Well, I think can wrap things up there. Right, the next webinar is going to be on how profits are made in the forex market. We're going to look at bid-ask quotes and what they mean, the base currency and the quote currency. We're going to look at margins and rollover, interest rate differentials. What is leverage? Because that's very important. And how do traders use leverage to make a lot of money using small amounts of capital? So hopefully you'll join me for that. Anyway, guys, thank you for joining me. Thank you to FX Primers. And remember, trade responsibly, guys. Take care. Cheers.